Hey everyone, Wobbly Draft here. I want to go ahead and review a very good article on valuing silver miners or miners in general. Give me 1 second. I'm going to share my screen and we will go over this. Okay, so here's a nice article. There's plenty of other articles and research papers on this sort of topic. I think this one's a little more digestible than some, and it goes over how do we value mines within their industry. Okay, and one thing, these articles and papers are very quick to, excuse me, I'm getting some coffee. I love coffee. One of these things that a lot of papers in this article are quick to point out is mines typically follow a different way of valuing the mine. Okay. So a lot of financial analysis that we might use for other businesses to determine whether they're a good investment or not are not necessarily the best ones to use for these mines. Okay. So let's go over this article. This is by a Glenn C. Thanks very much to him for providing this article. His full name is Glenn Chan. Check out his website at glennchan.wordpress.com, and he probably has a bunch of other great material. Okay, so going over this article was published a little bit ago on July 8th in 2015. The title is Mine Economics Explained. Okay. This will be a long post that covers what a mine's cash flow looks like over its life, the crazy accounting rules for it, and uneconomic behavior caused by stock promoters and charlatans. Word of the day, charlatans. That's a good word. So let's step through this. He talks about the discounted cash flow. Websites such as Investopedia have general background information on discounted cash flow models. I would argue that investors should use a discounted cash flow DCF model as a way of modeling the economics of a mine. Investors should not use PE multiples, EBITDA multiples, or price to book ratios because those models fail to take into account the depleting nature of a mine. Okay, so right there, we already have kind of this thesis of the article. He's going to dive more into that. We'll go through it. I want to point out that P to E multiples, EBITDA multiples, or price to book ratios are pretty popular in other stocks. Okay. So even just in that sentence, he's giving us a thesis that we should look at mines a different way than most other stocks. Okay. Continue on. As an example of a DCF modeling in mine, I will use table 22.5, assuming that's what this is, from a 2012 feasibility study prepared for Normand, which is a mine. Click the, actually, is Normand on mine? I've heard that before. I don't want to spread misinformation. Yeah, it's a Canadian-based mining research company. Okay, cool. So here is a table. Let's zoom in. The base case life of mine annual cash flow. Cool. Hopefully this is a little readable. I don't have a way to scale it, so I'm just going to kind of zoom in and out. A lot of mines, mining companies have this sort of thing on their website. Not necessarily this cash flow, but they'll have reserves mine, aggregate mine, okay? The life of mine total, spaced out across years. I don't think they give it to us this cleanly, but we usually get some sort of information on this of how much they expect annually for how many years, right? Continuing on, we have our processing plant production. Okay, nickel, copper, platinum, palladium. I hope I'm saying that right. I don't really care about that. Gold, nickel, copper, all that stuff repeated. They don't have silver. This isn't a silver miner, but the principles are the same, right? Okay, so we're going to get how much they think they're going to mine across the years. So we get a bunch of numbers there. Fair enough. They have the payability. Okay. They try to figure out essentially how much they're going to get for each metal. In this case, once again, typically concerned with just silver. Now they're going to have their net smelter return. So that's NSR. We'll see that quite often for a lot of the mining companies. Okay. So they're trying to give us a US dollar figure of how much they'll be making on what they smelt. Okay. Okay, we have a bunch of numbers there as well. So after they've mined it, after they've processed it or smelted it, they then are going to take that to market. Okay. So based on that, we then want to determine their profitability, right? Which means they're selling that refined ore, in our case, silver, for money. So they get revenue from that. We then will want to take out their cost to determine their margin in this case and work down the way till we have cash flow profitability and whatnot. Okay. And that's the second part of this. It's less the mining numbers and more the financial numbers. Okay. So we have our cash flow forecast where they're taking how much they made from smelting after mining. Okay. They're calculating their revenue. Fair enough. I'm assuming royalties is probably how much they're paying for the land of the mine, and other sort of things. I'm not sure if taxes would be included in this. I know like Mexico, some other countries have that value added tax. They call it something slightly different. That might be included in there. Not too sure. Anyhow, royalties. So after we've smelted it, taken it to market, made some sort of revenue, we want to subtract the cost of running our business, right? So how much did we spend mining it, right? Running the rigs, paying employees, that sort of thing. How much did we pay processing it? How much did our refinery cost, or I guess our processing plant? How much did the materials to run that cost? Electricity, that sort of thing. We then have infrastructure in this case, right? So roads, whether taking it from mine to plant, taking it from plant to the market, what have you. G&A, that's just another broad category for that. And we calculate our operating margin. Okay. So we've taken our revenue, we've minus our costs, we have our margin. Cool. Very common financial, excuse me, very common financial process, right? Doesn't matter what business we're doing, we're trying to get our revenue minus our costs to get our margin, or our operating costs, excuse me. Then we're going to subtract our capital costs. So mine development, whether they had to build stuff in the mine to get the ore, the mining equipment. Oh, I guess some of what I said was in operating costs, actually in capital costs. My bad. Don't shoot me. So we have our mining equipment, the rigs, whatnot, our processing capital, the infrastructure. So building the roads, I would assume, and our indirect capital costs. So fair enough. So yeah, I guess I made a bit of a boo-boo. Operating costs would be running that stuff. Capital would be more building it. Fair enough, right? I got those two a little confused, but that's okay. No biggie. Been a little bit of time since I've looked at this sort of thing, but it's coming back. It's sticking with me. Okay. So after we've taken our margin and we take out our capital costs, we're essentially coming to a more clear final answer of how much money we've made, right? So we have our pre-tax cash flow. We have our tax payable, right? So how much we owe on what we mined and whatnot. Cash flow after tax, our cumulative cash flow, our discounted cash flow at 8%, and our cumulative discounted cash flow. And we come to our max funding requirement to positive cash flow, right? So this is a very important number from the context of the article, in that if they're in the negative here, and this is what I've seen a couple of the mining companies talk about, if they're in the negative here, they have to raise more capital, get loans or other things to get their company in the positive here. Okay. I've seen some of the mine CEOs or presidents talking about how they need to either engage in share dilution, meaning sell more shares, like issue more shares, which increases the volume of shares and oftentimes will lead to a stock price decrease. Or they would need to take bonds or raise capital in some other way, right? And we would not necessarily want this to be negative. That's not necessarily a bad thing per se. It just means we need to raise capital, right? We wouldn't want this to be negative forever. If this was something that was negative now, we would want to certainly improve that, and it would improve the health of our business based on that. Okay. So, very good example. I mean, a lot of numbers, but kind of our final answer in this case is we want to raise capital or improve it over time, whether through the increase of price of what we're mining, which mines don't necessarily have a direct control over that. There are quite a few mines. They can't necessarily just go, hey, I want more money for what I'm mining, right? They are market takers in that regard. If this company was a monopoly, then yeah, they could just be like, hey, we're going to raise prices tenfold, which is not a good thing for a free market economy. Excuse me, my cat's running all over everything like he always does. I love him. I hate him. You know, cats. Get out of here. Get. Come on, baby. You know I love you. Just can't have you. He gets fur everywhere. You know, he's a cat. I don't know what to say. Knocked one of my cords that's making I have a loose cord on something that makes Windows do that constant noise back and forth. Very aggravating. Anyhow, continuing on. There are many assumptions behind a cash flow model. No political risk. Obviously, we didn't see that in there. Clear legal title. That's very true. I know some of the mines have mines split as well, and some other mines are engaged in legal litigation over land, right? So that's not captured by this by any means. Mineral estimation. Mines do this elsewhere. So yeah, it's not in there, but we would want to see some sort of studies on how much silver, in our case, or any commodity, is estimated to be, estimated to be in that mine. Cost of labor, right? Paying workers, whatnot, taxes, mineral production, commodity prices. Once again, for commodity prices, a lot of mines, in our case, silver mines, are assuming a price of silver. Silver Crest Metals assumed like $16 an ounce because for a very long time it was that price, right? Okay, et cetera. A single spreadsheet simply summarizes all of the underlying assumptions. A key line in the spreadsheet is the projected after-tax cash flow, C/flow after tax. He created a graph of the numbers below. So if we look in here, we'll see at the bottom, he has that C flow after tax. So positive, the total is positive. We see it's negative, and then it flips to being positive. Okay. And that's pretty typical. If we're starting up a project that involves capital, we're going to see negatives, but the end goal is growth. Get that to be positive. Okay. So here you go. We can see it's negative. After 1 year, it is then positive, but it looks like it's decreasing in general for the life of the mine. Okay. In general, the cash flow of all mines have some resemblance to the graph above. In the initial years, there is negative cash flow as the mine is built. Yeah, right. We're spending money to get the mine set up. We haven't mined anything yet. Okay. If exploration and engineering costs are included, the Noront feasibility study excluded such costs. These costs would also contribute to negative cash flows in the early years of one setting up the mine, but also probably mining it, right? So we might see this be a little less as well. Okay. Many feasibility studies for publicly traded companies underestimate the amount of time it takes for a mine to be approved. Fair enough. So not necessarily legal or unethical, but one event or another can happen that, hey, we had to delay this mine for X reason, COVID-19 being one. A lot of companies had to essentially shut down for a extended period of time worldwide. In first world countries, it usually takes 7 to 10 years from initial discovery of a deposit to initial production. Okay, interesting. I've definitely seen different numbers on that. Typically, I've seen longer. So we'll definitely want to check into that. Technical reports often underestimate delays caused by politics, not in my backyardism. So once again, a lot of times ranchers who might own part of that land are going to take that to litigation. That happens quite often. It seems I've seen almost every company have 1 or 2 properties that are engaged in litigation. Environmentalists, et cetera, et cetera. Fair enough. A mine plan tries to maximize the net present value, the NPV, by mining the most profitable ore first. Fair enough, right? And that it's not necessarily a bad thing, but that's why we also might see this go down over time, because now they're scraping the barrel for less. Excuse me, I gotta sneeze. By mining less higher grade silver or whatever commodity they're mining, right? Because of this, cash flows decline over time, right? So high grade silver in our case, well, in their case, gold, nickel, copper, whatever. Low grade gold, copper, in their case, our case, silver, right? This is an important concept to grasp, as producing mines will generally have their best days behind them, while management teams often claim that future will often claim that future that's a tongue twister for whatever reason. I don't even think it is. Claim that future cash flow will increase. It is unlikely that such claims will turn out to be true. And this is something I've seen Chris Ritchie from Silvercrest Metals talk about a little bit, not necessarily directly, but a lot of the bigger mines don't want to take risks in the mining, because if you choose a mine that turns out to not be as high grade or as much ore there as was thought in, say, a feasibility study, or just at the time of purchase of the land, setting up the mine, doing whatever, they will miss out on the high grade ore. So they'll be buying the mine like here. And while it is a little more stable and less risky, the best days of the mine are essentially behind them, right? So we would want to look at mines that are trying to engage in that heavier exploration, which is more risk, but has a much higher payout and is more stable in the long run, right? Okay, so let's read this again, just because I do think that is pretty important. A mine plan tries to maximize the net present value by mining the most profitable ore first. Because of this, cash flows decline over time. This is an important concept to grasp, as producing mines will generally have their best days behind them. While management teams often claim that future cash flow will increase, it is unlikely that such claims will turn out to be true. Okay, the table above does show some year-over-year increases in cash flow. This can happen when there is a lot of rock that must be removed before the next most profitable ore can be mined. In other words, there are less profitable rock in the mine that must be removed first before the company can get the higher grade and make more money. Okay. So we see year-over-year increases, like right about here. So they had to remove some less profitable rock here, and then they found more profitable rock here. Same here, they mined excluding this, but they mined a bunch of very profitable rock here, and then had to remove a lot of rock to get to this final point. Yeah. And you could argue maybe the beginning of the mine is the same way. We're setting up the mine, we're just digging out regular rocks at this point, and then we go into production and we're getting silver or what have you, in this case, gold, nickel, blah, 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 right? Okay. So based on what he said, if we make a general correct assumption that cash flow will decline over a mine's life, contrary to what some mine managers say, then there are obvious implications for short selling. Valuing a cash flow negative mining asset becomes easy if we can project that future cash flow will be worse than the past. And we can see in general, right, the best days of the mine are after we mine, we set up, we're getting that high grade stuff to pay off any debts or whatever. And we can, we just start kind of settling in a groove and getting that regular general trend along here. Okay. Valuing a cash flow negative mining asset becomes easy if we can project that future cash flow will be worse than the past, which I think is a fair assumption based on what he's saying. Problems with the DCF models in practice. In my opinion, discounted cash flow is an excellent tool that investors should use for mining assets. Mine engineering textbook focus on discounted cash flow as a tool that mine engineers should use in feasibility studies. However, there are problems in practice. Always important to note that sort of thing. Feasibility studies prepared for investors are often inflated. Fair enough. For example, the Bloom Lake feasibility study prepared for Consolidated Thompson wasn't anywhere close to reality. Okay. Um, blah blah blah. The mine is currently shut down as ore prices have fallen below the mine's operating costs. Okay, fair enough. Junior miners often withhold material information from investors or release misleading information. Okay, definitely should be a way to look in that. For example, Graham Farquharson, I don't know if I'm saying that right, from Strathcona, did an interview in the Northern Miner in response to Pritium's comments about Strathcona's views. In my opinion, Pritium Sadar, which I believe is that the SEC or is that Canada? I'm gonna assume that's Canada. Could be wrong. Yeah. Okay. Canada. I want to make sure. America has Egger, I believe, is the SEC. In an ideal world, this would not. Where was I? Excuse me. In my opinion, their SEDAR filings tell a very different story and omit material information disclosed in the interview. In an ideal world, this would not happen, as their securities regulator should have forced them to disclose what he was making us think about, as well. Their NI 43-101 technical report should not have omitted the disagreement and views when describing the history of Pretium's flagship deposit. I like this third point. Some mining CEOs are crazy. I want to know more about this. They intentionally chase uneconomic projects. Interesting. In the junior mining world, this often happens because the part-time CEO wants to raise money by telling a great story. Sure. A mothballed mine on care and maintenance does not make a good story. Raising money ensures that there will be money for the part-time CEO salary plus travel and entertainment expenses. Yeah, fair enough. See that in a lot of companies, not just mining. Some senior miners adhere closely to GAAP, so that's the general, what is it? General accepted accounting principles, I believe, which was established in America, I believe. Growth at any price. So that's generally what a lot of publicly traded companies will publish in forms, filings, whatever, to the general public. Because of growth at any price, many gold stocks have performed worse than physical gold during a bull market in gold. That's very interesting. I did not even know that. I can't seem to find data easily on historic mining companies' prices. I would definitely want to know more about this, especially in the context of silver. I've gone a little bit over the bull markets in silver and the percentage growth in the price and a lot of other things. That would be very interesting historical information to see for gold and silver, really any commodity price. I'm interested mainly in silver, but I would like to see that for gold as well. That's kind of scary when we think about it. But what he's saying is because a lot of these mining companies were not trying to follow good accounting principles for their sector, for their industry, mining, and they were more or less kind of legally fudging the books and painting a rosy story of their company that wasn't true, they did not benefit from that gold run. Okay. I think my company that I'm interested in, Silvercrest Metals, I very much like the team. I think Chris Ritchie has been a lot more transparent and better about following proper accounting procedures to paint a good story of his mine. To paint to paint an accurate, realistic picture of his mine. And a lot of their numbers are very conservative. So they assume a fixed price of silver that is much lower than it is today. I know that there's something else in here that stuck out to me. Give me 1 second. I know something else in here stuck with me there, but something they talked about is they have tried to overestimate costs. I know something Chris talked about is they wanted like 40 or so million, maybe it was some more, but they wanted quite a bit of money to act as a cushion. And he said it was for the unknown unknowns, right? So he was like, we've tried to cover any negative angle in terms of a market downturn, and so we have a cushion that we can reliably rely upon if there is just some out there event that should cause a lot of issues for our company. So to me, the Silvercrest team, especially the president Chris Ritchie, has tried to be very. Oh, excuse me, I didn't know that was awake. Oh, hey, you might have data on that. Nice. I'm gonna read that as well. Um, but it seems like Silvercrest Metals and Chris Ritchie have been very conservative in their accounting in order to obviously not fill point number 3, right? They are trying to make a very good business that is not chasing money right away, right? Okay. So number 4, often mining companies do not disclose enough information for investors to build a decent DCF model and to perform due diligence on the assets. Fair enough. I will say it has been somewhat hard to do research on some of these mining companies. Um, Part of that is that there's no standard format, unfortunately, for a lot of these websites. I know a lot of the forums do follow consistent, I mean, legally they have to do follow consistent formats. It's very frustrating when I get a bunch of different numbers and different data from mining companies. And that's part of, I think, painting a rosy picture that they can come along and be like, oh, look at this number. We're the best in this number. And like that might not be a realistic number for for that sector, or a realistic metric, excuse me, for that sector to be kind of building itself, that company in that sector to be building itself on. So yeah, it's not even that they don't disclose enough information. It's a lot of the information that's disclosed is hard to synthesize with information from these other companies, right? In the same sector. Might. Okay, so investor communication. In an ideal world, institutional investors would perform a reasonable level of due diligence on their mining stocks. In theory, they could request publicly traded companies to publicly disclose any feasibility studies produced for a mining project, either internally or by joint venture partners. In practice, they raise capital to build mines without releasing any feasibility studies. So this was published a couple years ago. I think mining companies have gotten a little better about it. I'm not sure that I haven't seen any of the big players not doing it, but this is certainly something to keep in mind going forward in my research. Ideally, mining companies could, at the very least, release basic information to investors, the net present value and the internal rate of return. So I've seen quite a few companies do this. The grade, so the gradage per ton of the silver, the gold, or whatever mine it is, in our case, silver. The mine life, I don't think I've seen a lot of companies do that per se, and that's a big one in my opinion. Estimated production removal of waste ore for each commodity produced, in this case silver or gold. Estimated metallurgical recovery rates. I think I've seen most companies do this. I have seen some not, and I do think that's a big important part of calculating their profitability and some of these other metrics. Remember, our formula for silver equivalent is we're taking any metal we're mining. So let's say we have gold and silver. We're taking essentially the amount of gold we're mining times that recovery rate to get like how much gold ore we have at the end of the day. Plus, so we're doing silver equivalent. We just did the gold. Then we would do our recovery rate of silver times the amount we have mined, right? So fair enough there. I think that's pretty important. And that's very specific to miners, right? Okay, so that's cool. Estimated operating costs, initial capital expenditures, and sustaining capex. Also pretty important. I think something that's been brought up is a lot of these mining projects, and he kind of covered this before, are essentially capital destroyers, right? They are getting a mine, and this kind of goes back to point 3. They're getting a mine that is not profitable or economically smart. Um, and I lost my train of thought. Excuse me. They're getting a mine that's not profitable, and then they don't necessarily have the cost and this capital expenditure baked in. And so what happens like after that mine is over? Does that company just go out of business? So this is also to me is a very important number because like we want to know, is that mine going to survive past that mining company? Are they going to survive past these next couple of mines they have? I think capital expenditure definitely plays a decent role in that. Allocation of estimated corporate overhead. Okay, fair enough. Later on, actual production numbers should be provided so that the investors could compare projected versus actual results. Yeah. We want to know, was the mine projected to have 20 million silver ounces, and did it only have 10? Did it only have 5? Did it have 30? Did it have 40? I think that's pretty important. The level of accuracy of the feasibility study. So I think these two kind of go hand in hand. Same thing, right? We don't want a super positive feasibility study that then after we find out the actual amount of silver, gold, etc., that was mined was nowhere close to what was projected, right? This information could allow investors to build reasonably good discounted cash flow models. The obvious problem is that discounted cash flow can be a garbage in, garbage out model. Exactly. If we don't have accurate numbers, we're missing numbers, not useful. If a promotional management team releases inflated numbers, then the investor's DCF model could wildly overestimate a project's economics. A basic safeguard against this is to compare actual versus projected results of their mines. Okay. So that's pretty important. I'm going to keep that in mind. To perform more extensive due diligence on a discounted cash flow model, investors should look at political risk, not necessarily baked into that initial report. Something I'll say right off the bat is I know one of the bigger miners had a very good mine. I believe it was in Peru, and one, it was shut down for political reasons. And the next candidate that's running for president, I believe they have, is very against mining. So he's like, I'm not going to let them mine this. That's political risk. It's like, yeah, they could make a lot of money on that mine, but they're not going to actually be able to mine it. So that's a huge deal. Whether the company has clear legal title to the deposit, once again, it seems like most mining companies have one or two mines in litigation. So that's important to keep in mind. The reasonableness of various technical assumptions supporting the engineering projections. This is very complex as it requires domain knowledge in civil engineering, mineral processing, resource estimation, mining, engineering, etc., etc. Yeah, I don't necessarily have that knowledge. Certainly something to look over, see if I can develop some insight in that. That is domain knowledge. That applies to any business any business, not even just mining. We do want to kind of know the industry they're working in. So fair enough there. The 3D model of the ore body to verify the reasonableness of the mining estimation model. I think that's good. Personally, I haven't found that necessarily helpful. I mean, the more information, the better. But I have seen companies that miss numbers on their website that I personally would find better and more able to work with. And then they're like, oh, but we have a 3D model. And I'm kind of like, I don't know how to use that to gauge the numbers and develop that clear picture. So certainly helpful. I am not a fan. Which this next line makes me giggle a little bit. It's highly unfortunate that few analysts see the value of performing this check, as looking at the 3D model can reveal common ways in which a resource is inflated. Now, that's a very good point. I never thought about that. If we look at the 3D model of what they had originally and then how the mine turned out, we can see, was it inflated or not? Once again, I think that can be done personally by looking at the actual versus projected results in a numeric format. But if we get a 3D picture of mine, it's like, oh, our mine is huge. And I see people drawing like what looks like galaxy brains of their minds. And then like we see a 3D scan or what have you after, and it's like not a brain, it's a toothpick or something, like, oh, we got some like silver. Yeah, then we have a very clear answer that I don't have to go dig into the numbers to see. So, maybe I'll revisit this for some companies that have put that on their website. So very interesting. Never thought about it that way. Assay, I don't know how to say that results. Companies should not omit assay information for unwanted elements. Very true. Sulfuric, arsenic, etc. We want to get a very raw idea of how much they need to mine to get how much ore. Are they disposing of this unwanted stuff, right? If they have a super high silver mine or gold or what have you, but they have to dig through a bunch of sulfur and arsenic that needs to be disposed of or handled with care or special, more expensive equipment to you protect workers, protect the environment, etc. That increases our costs. Okay. So independent essays on drill core splits. I have seen most companies do this. This is important. And I think this plays a little bit in the feasibility studies of hiring an outside company to come in, independently audit and give a accurate picture of what they think is in the mine. For Silvercrest, I know they've done this, and usually they do better than that conservative estimate. So that's good. Um, and that's nothing against the independent auditors. They're trying to make a base case estimate of what the mine holds. And that always generally is going to be, if we're not pumping the numbers, or we're not hiring a corrupt company, that always probably will either be close in line or worst case slightly overestimate. But we would hope it probably slightly under cases or understates how much ore is actually in there, because they can't mine the whole mine. They're just taking surveys and then be like, all right, based on probability, this domain knowledge we have of mineral engineering, civic engineering, and metallurgy and what have you, um, we're making a base case of what we think is in this mine. So yeah, fair enough. This verification is the reason why Freeport McMoran didn't get burned on BRIEX. I'm assuming that's a specific mine they have, while every other investment bank analyst failed to spot the fraud. Yeah, exactly. Right. We want some sort of independent accounting so a company can't be like, hey, we have the best mine in the world. And like, they don't. Right. So, very important. What actually happened is that BRIEX destroyed all of its drill core. So Freeport McMoran brought in their own drilling team at great expense to obtain new drill core. Okay, fair enough. So he is opposed on data verification. I'll be reading this as well. So we want our operating cost assumptions, such as the number of employees, whether we need more or less, wage rates, use of fly in, fly out labor, et cetera, et cetera. Fair enough. I think a lot of mining companies I've seen typically do hire local. Maybe they need to hire more or less. You could argue, if you need specialists, yeah, that'll be that fly in, fly out sort of thing. So the integrity of management, yeah, right? Are they lying? Are they lying about their reports? Yeah, exactly, right? So performing actual due diligence requires sophistication in politics and law on top of various different disciplines in engineering. It's going to be hard. Interestingly enough, institutional investors rarely perform such due diligence. Yeah. And that's something that attracted me to the mining sector in general, that a lot of these big banks or just institutional investors in general have algorithms that are looking over all of these accounting books that are being published or just publicly available information, but they're rarely going into um, the deep end for these companies and trying to evaluate, is this actually a good investment? So they'll look at the books and be like, oh, this company looks great on paper. Here's $10 million. And you might have this sort of issue with Freeport McMoran, um, where, well, I guess this isn't the best best example, but that excuse me, let me gather my train of thought. But institutional investors might look at the books and not see, like, was this independently audited? Are they inflating their numbers such that they have a mine that is mothballed and where was that? Mothballed and being over, hey, we're better than we are. Um, that sort of thing. So institutional investors are not doing the due diligence in this sector, and that leaves the opportunity for other retail investors, myself, and institutional investors willing to do the due diligence to make a lot of money. Because one, those other companies will probably go down in stock price. Two, if we find a good miner or two, we're going to make more money than the others. Those mines are best set up to take advantage of the bull run. Um, and be a good long-term investment, as well as short-term. Probably some other goodies thrown in there, but that's probably the best I can think of off the top of my mind. All right, so continuing on. The underlying problem. So the biggest issue in mining is that there's various uncertainties, absolutely, such as size and grade of the resource, operating costs, metallurgical risk, etc., etc. Because of the uncertainties, it can be difficult for investors to build accurate models. The uncertainties will always create room for charlatans to game the system and to mislead investors into overestimating a project's economics. I don't see a great solution that could prevent charlatanism from happening. Absolutely. However, I think the most pragmatic approach is for mining companies to disclose more information about their existing mines and potential mines. Insiders should not have an information advantage over investors. Investors should be given access to feasibility studies, internal and joint venture, 3D models, assay results, etc., etc. Basically, investors should be provided with more information to help them form their own conclusions as to what a mining asset is worth. Accounting rules. Generally speaking, accounting rules require mining companies to estimate the life of the mine, the LOM. To do this, the company will likely be using a discounted cash flow model to model the economics of the mine. However, I don't believe the accounting rules actually require the company to disclose the details and assumptions of the DCF model used. So we, as myself, as retail or institutional investors, want to probably establish that ourselves, myself, not a financial advisor. I gotta say legally, please don't shoot me, SEC. We want to probably make myself. I think I'm legally allowed to say we, but hey, it's the we that's God in me, not we as people, I guess. SEC, man. So we, God and me, want to try and establish a DCF model and probably make the same assumptions per company. And if we find something that we at a later stage think is a bad assumption, we want to revise all of those models so we can have a very similar picture. And I think that's what I'm taking out of that. But ideally, we would want the mining companies to do this openly and honestly. So suppose that the units of production method is used to determine the depreciation expense for a mining asset. This method likely requires both a discounted cash flow model, as the company needs to estimate mine economics to estimate the total number of units produced. Fair enough. I think that comes down to a million of ounces of silver, 1,000 or 100,000s for gold, etc., etc. Companies do not have to disclose the DCF model or the projection, excuse me, the projected production for each year. Not enough fair. In general, commonly used accounting principles do not help investors in value mining assets. Investors should overcome some of these issues if companies could overcome if companies were forced to disclose more information. So yeah, fair enough. Okay, so capitalization of stripping expenses. They need to remove waste material, arsenic, sulfuric sulfides, I guess, whatever, or just rock, right? And just dispose of it. IFRS accounting standards force the mining company to capitalize the cost of removing waste material for surface mines. So I know I've seen quite a few mines use this accounting, so that's good. The argument is that moving waste material improves access to the ore body because expenses should be matched to the time period that the revenue is recognized. Some stripping costs are capitalized so that the expenses recognized in the future time period. Yeah, so we could see companies like moving around the cost of disposing of that to make themselves look more profitable or have more revenue in the short term. And yeah, that's questionable. In the normal operation of a mine, waste may need to be removed a month or weeks ahead of time. Access ramps and declines are needed years in advance. Open pit operations, there will be more waste material for secondary pits. The mine operator may delay the removal of that overburden until they're ready to mine the secondary pits. Fair enough. Let's see. So I think it's unreasonable for waste removal costs to be capitalized for several years over the life of a mine. Yeah, something to look out for. In my opinion, capitalization creates accounting distortions. Another way we can make a mine look better or worse than it should be. Dirt or waste rock is not an asset that generates revenue. They could move it around because they have to, not because they want to. They want to minimize that expense. The cost is unavoidable. They want to defer the cost as much as possible to maximize the net present value of the mine, which is not necessarily what we want for a realistic picture for the company. Generally speaking, mining companies move dirt around to make money in the short term rather than sometime in the future. Capitalizing stripping expenses over long time horizons inflates accounting earnings in the short term with offsetting accounting losses in the long term. In practice, some companies abuse this accounting rule to inflate earnings. It is worth searching through annual reports for the phrase capitalize to find capitalization to figure out whether or not the company is capitalizing stripping costs excessively. Fair enough. While accounting rules generally force all miners to capitalize stripping costs, they find loopholes to capitalize far more costs than their peers. Fair enough. Excessive capitalization of stripping costs is likely a sign of dubious management. So definitely want to visit that in our research. In my opinion, it would be simpler if stripping costs were always expense. The accounting burning on the company would be lower. Comparatively, would be better as there will not be a situation where companies capitalize excessively and some don't. There would be significantly less abuse. One minor downside is that capitalizing all stripping expenses violates the matching principle by a very short time period, usually weeks, month. Very little accuracy is lost since they do a terrible job, the accounting rules, at approximating the actual economics of mine. Anyways, marking the mine to a DCF model has the potential for being more accurate. Fair enough. So for more reading, read that, which I will at a later date. Excuse me, allergies. Hidden value. Often mining companies will defer exploration of deep targets until after exploration or production shafts are sunk. Because of this, initial resource estimates can be revised upwards due to new discoveries, right? Yeah, whoa, our mine turns out to have way more silver than we thought. Well, they were avoiding essentially that mine until their accounting numbers or their costs were already dispensed or what have you. So it's like, oh, we're more profitable because we have lower costs and we're now getting more of the ore, and that's not accurate. So one reason why mining companies defer exploration is because deep drilling is expensive, right? We're going into the earth more. Hey, kitty. So we need probably more specialized equipment, more drill time, et cetera, et cetera. I mean, at the very least, it's harder to get the ore deeper out of the mine. It has to go up more mine shafts to get to the surface. A shallow exploration hole might cost 100 a foot, while a shallow might cost 100 feet, while a multi-kilometer hole might cost $300 a foot. So costs are going up, as well as exploration holes curve and increasingly go off target the longer the hole goes. Fair enough, right? So shallower, it might be a straight vein of gold or silver or whatever. Deep down in the mine, it might be more twisted, which definitely involves more hurdles to get it out. When the project turns into a mine, the exploration shaft can be reused as part of the mine's infrastructure. Okay. Kitty, stop playing with the blinds, baby. Mine life. Before a mine is built, mine engineers will conduct various studies to examine the relationship between the size and the MPF of the project. A larger mine, its cash flows are received sooner because ore is extracted faster. Various economies of scale exist. Exactly. And that's something we want to look at for a lot of our miners. Silvercrest miners, they have a second mine that's very close to the first, so they can dig out the ore that's economical from that second mine, take it to the factory that they built at the first to process instead of building a second one. That's something like economies of scale. Now, in this case, he's talking about specifically one mine, but the same sort of thing applies, that we want to look at these situations for these mining companies that might save them some money or help them get more silver, in our case, gold or other ore, while saving on costs and these other things. That's economies of scale. The downside to a larger mine is higher capital expenditures. There is some optimal mine size that that balances out the benefits, and the downside optimizing the NPF for the project. Fair enough. Uh, I would like to know more about what he's saying there, but if we had a larger mine, do we have to spend more money on tunnels or holding up the different shafts or what have you for the mine? I'm assuming that's what he's talking about. I'm not sure. And that's one of the reasons, at the very least, that I might stay away from larger mines. I've been asked from a lot of people just my thoughts on why not go for this larger company that has a bigger silver mine. And the answer, generally speaking, is they will have a higher cost per ounce of silver to mine. So it's less profitable. It's like, yeah, they got more silver, but they're making less money per silver ounce. Mechanization is one benefit of scale. Larger machines, for underground operations, larger machines may not make sense if the deposit consists of small veins. They would be detrimental to their size, etc., etc. Typical mine lives. MPF is usually maximized with a mine life of between I don't know why I said 6 and 20 years. I guess I saw the 2 and 20. Underground mines tend to have longer optimal mine lives due to limit. My English is just going whatever. They have longer optimal mine lives due to limitations of mechanization, higher capex intensity due to the cost of mine shafts. Yeah, so it goes a little bit in their hoisting equipment, etc., etc. All right, so mine life's longer than 20 years. He's skeptical about feasibility studies that claim more than 20 years. You get my inhaler, everyone. How about that? So get a little bit of that oxygen. Okay. So yeah, we don't want to assume a mine is going to last 100 years, 50 years, even 30. For big deposits, a very high mine life is reasonable if the mine is so big that it can oversupply the local market. Fair enough. So what happens as well as the feasibility studies probably greatly understating the operating costs. And it kind of goes back to they probably have to spend more money on getting the ore out, whether it's more mine shafts or whatever. So paints a way more rosy picture than should be for this company. With more accurate accounting cost projects, the mine life would be something more reasonable. Fair enough. So multi-stage mines. I'm very skeptical about mines that will be built in multiple stages. He has another blog post on that I'll look through. The NPF of a mine would be maximized if the mine was built in a single stage. Absolutely. By proposing additional stages, charlatans can claim that the increased scale will produce economies of scale. They can make the claim that the improved operating costs will make the expansion feasible. In practice, many mine expansions seem to be an exercise in fooling gullible investors when the economies of scale do not materialize. To be fair, mine expansions can make more sense when commodity prices have risen dramatically. Merger synergies. In theory, mines close to each other can generate some synergies by sharing spare parts and eliminating duplicate personnel. Yeah, and that's something I'm talking about a little bit here. I'm not talking about merger between companies, but yeah, Silvercrest Metals has two mines close together, so they don't have to build two processing plants. That's a very clear-cut example. In practice, synergies can be achieved with joint ventures. So I do know that Fresnillo, and I think it was First Majestic. I could be wrong. It might be Majestic Silver. They have a joint venture of a big silver mine in Mexico, so they're sharing factories as well, which lower that cost as well. So yeah, good example there. For example, Nora and Cliff Natural Resources show an exploration camp in the Ring of Fire area. An extensive merger between the two companies was not necessary to generate synergies. Where mergers do occur, mining synergies do not seem to materialize very often. Fair enough. What I would also add is something that Chris Ritchie pointed out is a lot of companies are capital destroyers. So in the long run, they're not profitable. and they will have to either dilute their shares or merge with another company that kind of makes them look better. Like, oh, we merged these two big mining companies. We have more bigger silver, gold, or etc. mines, when in fact both companies are not. If we looked at their a more realistic accounting picture of their company, that merger doesn't mean anything good, right? So in my opinion, mergers between mining companies often do not make sense. Usually when a mining merger happens, one party is taking advantage of the other. Both companies may have flawed assets and looking to do deals to get out of the predicament. One party may have a mothball mine that doesn't make a good stock story. However, the management team of one side may not realize that the other company assets are more flawed than theirs. Yeah, so that's not good. Of course, many companies will pursue strategies that are the opposite of a merger. They might spin off assets into pure play companies that focus on a specific commodity. I do not see the value of companies shuffling paper around with mergers and on merger spinoffs. Fair enough. Okay, so that's almost the end of it. What this guy actually does is he's fearful of the garbage in, garbage out problem with DCF models. He rarely builds them. He knows his limits. He understands that he cannot perform very good due diligence on mining assets, as publicly traded miners typically provide very little useful and reliable information on their assets. They're filled with charlatans, promoters, and smart people trying to sell shares at inflated prices. The short side is easier than the long side because it's easier to find good people, bad people with bad assets than find good people with good assets. Yeah, fair enough. Okay. So I'll do some more research in that. I just found that article. I found that was very interesting. I wanted to share that because I think that establishes a lot of the groundwork for my future. And I've already performed some of it, but it provides a better framework moving forward for a lot of research in these silver miners in particular, but the mining industry overall. So thank you. I hope this video helped you learn about not only mining companies, but finance in general, some financial modeling, some of these terms, and just looking at the stock market in general. So thanks very much. Once again, my name is Wobbly Giraffe. I am signing off. Have a good day and a good week. Until next time. Bye-bye.